to Selfwealth Live, our technical analysis edition. This week we're going to be talking about reversal patterns, tops and bottoms. This is something that's really, it's really going to be interesting to learn about. We're just waiting for Jason to join us. I just want to say apologies for last week and not being there. We just had something turn up. So once again, we just couldn't be there last Tuesday, but we will be with you for the next three sessions, I think. This just for your information, this was a bit of a 12-week trial program, trial work, see how we go, see what kind of feedback we get. So we'd really love your feedback if you want us to continue this. All right, we're still deciding on a bit of a format going forward. What we wanted to do was an introductory sort of course to technical analysis. It was something that's really true to my sort of nature in trading. I love the idea of technical analysis. So I've got the best in the business to come and help us along with that. But over the next 3-4 weeks, we're probably going to obviously, trying to work out what we're going to do in 2024 with this format of a show. So we'd love your feedback. We'd love if you obviously like and comment, but also send in some feedback via email. Whichever way you want to do it, and if you want us to continue. So welcome, Jason. I was just explaining to our audience here that this was an original 12-week pilot program, and we're wanting feedback now on what they want. And it was all about introducing technical analysis to the community and beginners. And even if you were a seasoned trader, then maybe you could learn something from it, right? But we want feedback now as to what you want us to do after we've finished this, and we've got about 4 weeks to go, right, including this one here. Today we're going to be talking about reversal patterns. How are you, Jason?
Roger, g'day. Good to be back on. And look, let us know the feedback. I'd like to be able to apply the technical analysis, get the stocks people are looking at, and talk about them, because it's always good to talk the theory, but then it's also what it comes down to in the end is actually applying it and looking for the ideas, the opportunities, considering the possibilities, managing the risk. That's what it's all about, and that's what we're here for.
Yeah, fantastic. And before we continue on today, Jace, can you talk about your disclaimer, please?
Yeah, the quick disclaimer. And look, the important disclaimer to go through, everything we talk about today is general advice only. So nothing takes into account your personal situation. And another important point is I'm not part of Selfwealth. I'm part of Motion Trader, and I'm come on to the Selfwealth YouTube channel to talk generally about markets and about process and technicals and that sort of thing. So I'm operating under a license provided by Chartreuse Wealth Management. So check out the disclaimer there, and general advice.
Thanks, Jason. It's like I just had the first comment here, saying that trading, depending on how you do it and who you do it with, can be a lonely game at times. And that's the truth. And I know when I try to do it on my own, I went off track a lot of the times, right? So it's so important to be part of a community. Sometimes they keep you accountable. And I hope this helps, with that process a little bit, which is great. It's great to hear, to be honest, because it's just that these are the ideas that you come up with, and you hope that you're going to help other people on their journeys, right? So it's great to hear that feedback that we're helping, isn't it, Jason?
Yeah. It is. And look, it's right. Trading can be, I guess it depends a bit how you're wired up. It can be a lonely game if you're a bit of an extroverted personality. You're used to being around, you like being around other people all the time. It can be, well, you're on your own and you've got your own ideas, and you can be a bit cocooned. I'm a bit more on the introverted side, so I don't mind sort of being in front of, getting a screen out or getting the charts out and looking at things. I'm pretty okay with that, but I do know what people mean by that, because I think also one of the advantages of being a little more on your own is that you don't get the clutter of other people's thoughts. It's good to get ideas, but you also don't want to be short-circuiting your own ideas by intertwining other people's processes in what you're doing. So I guess it's something everyone's got to work out for themselves, what works best for them. But Yeah, look, at the end of the day, we've got to make our own decisions. We've got to have our own process. We can't take a bit of their process, a bit of someone else's process, and try and do too many different things, because then things don't work. It's consistency, getting that nice ordered approach clear in your head and then applying it.
Yeah. Yeah, I remember when I first started trading, and I signed up to a very, very expensive course, and you'd have everyone there learning around you, and you just realize that whilst it's great from a social aspect, and you learn a little bit, but you realize it can be a double-edged sword, right? Because you end up getting everyone else's ideas, and you end up also going, oh, maybe I should take that, or maybe I should do that, and you end up having FOMO, and all these other emotions come in. So it's good to have a community, but like you said, Jason, it's also good to sort of, do your own thing as well, right? And sometimes that quietness can really allow you to focus.
Yeah.
Yeah. All right. Well, let's get on with today's topics, and we're talking about tops and bottoms, identifying tops and bottoms, and different ways of doing that. So my first question to you, Jason, is like investor sentiment. Is that a useful indicator to identify tops and bottoms?
Oh, look, absolutely. The old fear and greed, it's such a big part of the market and the way markets work. It's sort of like, you think about when things are going well and markets are nearing a peak, you can't have enough stocks. You can't, people want to have you loaded up on stocks, on ETFs. They'll look at margin type situations and just try and get as much exposure as they can. And this is after a market's been doing well for a while. But then you look at the other end, and when a market's bottoming out, well, it's bottoming out in fear. And usually at that point, people don't want to know about stocks. They want to have a mountain of cash. Nobody wants to talk about stocks. No one wants to have anything to do with them, because it's just not the place which has been working. So understanding that fear and greed cycle and where it fits in, it can help us identify where we might be within the cycle, and then be able to trade off the back of that. So I'll give you an example. I'll show you what I mean. So just sharing this chart. So this is the S&P 500, and I'm just going to go back to a couple of years ago, or 3 years ago. So everyone well and truly remembers the COVID crash that we had. So this was like a situation of maximum fear. It was a huge sell-off in a short period of time. Market started to rebound. So a couple of months after the low, around April, May, I started getting new buy signals through my Motion Trader system and sending them out to the members. And I'd get emails back from people saying, look, I'm just not comfortable following these signals at the moment. And then other people would be speaking to who were thinking about joining the service. I remember these people vividly, because they'd say, look, I love what you do, but I don't want to join now because I'm waiting for the crash. And it was really interesting because, well, the crash was a couple of 2-3 months beforehand. But here we are with the market rising off its lows, and they're saying, look, I don't want to get into the market now because I'm waiting for the crash. And this is typically what happens. It's a classic case of people looking in the rear view mirror, expecting a continuation of what they've just experienced. And what they just experienced was a historic crash. So that stays front and center in their mind. And for that, they find it hard to move forward. And then from a sentiment perspective, you can kind of gauge, well, maybe something different is happening. Maybe we shouldn't be focusing on the next supposed crash, but looking at, is there something else occurring, in this case, a rally? Similar sort of sentiment if we look back at October last year. So if you can cast your mind back to this time last year, we're waiting on CPI. The CPI numbers coming out of the US with a big deal at the time. And as the market was set up, it was sitting on its lows. It was sitting at the lowest point it had been since for nearly 2 years. It was nearly at a 2-year low. The CPI was coming out. The expectation was it was going to be a big number. There was going to be a whole lot more tightening, Fed tightening of the interest rates, and the market was going to really sell off hard. What was so interesting from a sentiment perspective was that CPI number came out, and you can see in this chart here, just move that a touch. you can see it just on this day here. You can see how it's opened low. So the CPI's come out, it's gapped lower on the open. There's been no follow through selling, and the market's rallied through the day and closed at a new high. So that was a sign that all the people who had wanted to sell had actually sold. And it was from a sentiment perspective, it was a turning point. And as it turns out, that was the low in the market. And what we can do, another way to look at this is, I'm going to show you another chart. This is an inverse ETF. It's US listed. It's the ProShares Ultra Short S&P 500 ETF. So the way this works, when the market sells off, the ETF goes up in price. So people will use this to hedge a portfolio or to speculate on the market falling. And what I want to do, I'm going to overlay this with a chart of the S&P 500. So let's just pop that up on the top, and I'll just position this around. And now what I want to do, I'm going to put a volume. So I'm going to get the volume traded in this inverse ETF. So let's get that down the bottom. And what you can see here, what's so interesting, so this is this low point we had in October when sentiment was just so bearish, so negative. And you can see how the volume of this ETF is rising. As the market's selling off, the volume's going up. So the market's getting more and more hedged, and people are getting more and more short. And then there's a spike in activity on the day of that the CPI release, where the market gapped lower and then started to rally. So that was your sign that all the people who wanted to sell, you can see the volume in the lead up to that, all the people who had wanted to sell had already sold. So we'd reached that point of maximum fear, and that became a significant low. And tops are a different matter altogether. Tops are generally associated with tops are associated with positive move, like really positive investor sentiment. So sometimes it gets quite euphoric, and this could be associated, could be around new technology. People might remember back to the .com boom. It was all about this new technology had come through, and other times it'll be economic conditions. There'll be these. The Fed governor back in the 90s, a guy called Alan Greenspan, he spoke about a new paradigm. So saying the economy was in this new state, and the business cycle wasn't what it used to be, and stocks could continue to rise. And this is the sort of positive mood that you get near market tops. And the mining boom, where you'd hear phrases like, "Oh, it's going to be stronger for longer." It didn't turn out to be the case at all. But this is what happens. You hear people say, "Oh, this time it's different." And that's all the stuff that you start to hear and see when you get at a peak in market. So you're looking for these sentiment swings where either people are very fearful or very, very positive and very euphoric, and then that can help us work out where we are within the cycle. And but I think the best thing to do, I think sentiment is really interesting, but I think it's best when it's combined with the price action. So not just going, "Oh, look, everyone's bearish, so the market's got a bottom." The market can stay bearish for quite a while, and the market can keep falling. It's got to be combined with the price action. I'll show you a really, really interesting example. Let me share this screen with you. So here we go. Here, this is a chart of Lehman Brothers. So everyone will remember Lehman Brothers was synonymous with the GFC, and there was I was talking with a prominent fund manager, and this was a few years after the GFC, and I was talking to him about in their reports. I was talking to this guy because I said, "Look, I think momentum analysis could help with the timing of the way you're positioning your fund." And this is a major fund. And we were talking about a short position they'd had in Lehman Brothers. So this fund had a big short position in Lehman Brothers and Bear Stearns leading into the GFC. And the timing of it all, they were getting short during the run-up. So they had a view that there was trouble brewing, and they were selling as the market was rising, but the market can rise for a lot longer than you think it can potentially rise. So they ended up closing out their positions prior to the peak. And then, of course, the market fell away and they weren't short anymore. So it was a case of, I said to him, look, you had the view, but you didn't wait for the price action. So using a view that something's going to happen, but then waiting for the price action to confirm it, there's plenty of opportunity too. Price sold off, sideways compression, then started to break down. There's a clear point if you've got that view on Lehman Brothers, rather than trying to short it as the price is rising. So yeah, look, Roger, I think sentiment can be really useful, but I think it's also a case of then combining it with the price action, getting that confirmation that the price action is confirming what you're thinking from the sentiment perspective.
Yeah, and when we talk about sentiment, Jason, do you have any like specific indicators that you look at, or is it just a combination of sort of what you showed there? Because I know there's a lot of sentiment indicators out there sometimes,
Yeah.
percentage of bullish and bearish and all that sort of stuff. Do you use any specific ones yourself, or?
Yeah, I'll look at the percentage of bullish and bearish. I'll look at a lot of things. There's not one specific thing. Put call ratios is another one. So when people are fearful, they'll buy a lot of put options versus call. And there's a ratio which is calculated, which you can see where it spikes higher when markets are fearful. There's not one thing. It's the AAI, so the American Association of Independent Investors do a bullish bearish survey. When that gets considerably skewed one way or the other, it's a sign that you need to be aware that sentiment's starting to get extreme. But it's not a case of just, okay, sentiment is extreme, so the opposite's got to happen. As I was saying, wait for the price action to confirm it, because the dot-com boom was a classic. It looked like the market was at an extreme for 12 months and had kind of doubled thereabouts within that time. So you don't want to jump off or try and short the market too soon, as I was saying with that example of Lehman Brothers. So take sentiment on board, and that helps you get ready for a potential turn, but wait for the price action to confirm it.
Yeah, right. All right. And okay, so what about trend lines? How can you use trend lines to help identify turning points?
Yeah, look, trend lines are an interesting thing. I think they can they can help you get a good visual of the general direction of the market. And I'll give you an example. So let's just jump back to the charts. So here's a great example of trend line. Let me just readjust this. So this is an ASX example. It's Domino Pizzas.
You've still got Lehman Brothers on the screen.
Right. Okay. Let me get rid of Lehman's, and let's go back to the. There we go. That's the one we want.
Yep.
Thanks for that tip, Rog. So here we go. This is Domino Pizzas, ticker code DMP. So this is from about 12 months or so ago, and you can see there's a really nice, clearly defined trend line on the chart. And like some people might look at this and say, look, the share price topped all the way up here, and the trend line doesn't break until sometime after. So it hasn't really helped us get out of this position early. But that's not quite the point. The trend line doesn't have to also be your exit point. You can have stop loss strategies or trailing stops, which could activate earlier on. What the trend line is doing is it's really helping you understand, I'd call it the temperature of the market. So as Domino's takes off in this big rally, you'd say this market's hot. And then it starts to pull back. It's still above the moving averages. So it's still a warm market. It's still a market which you could be considering. Maybe you're considering buying the dip. But then as it falls back to the trend line and gets below the moving averages, it starts to become a cooling market, and it breaks that trend line, breaks below a support level here, and it becomes a cold market. And this is an important important concept to take on board, because some investors would be saying, well, look, this is a great fall now. This is a time to buy the dip. But if you're aware of something like a general trend line, you can see a general upward trajectory of a share price, and then you can see that the market has, you get that clear visual. It's broken. It's severed that upward momentum. And that's really what the trend line is helping you do. It's helping you see that general direction has changed. So when I say it's a cold market, you don't want to buy the dip when the market's cold. You want to buy the dip maybe when it's warm. Doesn't mean it's going to go up, but in some of these other occasions, you can see buying the dip on a warm market works out well. You don't want to buy the dip when the market's cold, when it's broken a trend line, when it's broken support, when it's below moving averages. So this is the sort of thing that a trend line can potentially help with. And it just helps you see when the tide's going out and when it's best to stay out of a particular market. But I think good trend lines like this one on Domino's is hard to find. What makes this a good trend line is it's got multiple touch points. So you can see where I put these cups underneath the line, and that's where the price has come back, touched the line, rallied, come back and touched. So it's got 4 touch points. So that's a pretty good trend line. Well, actually, it's a really good trend line. But often I see trend lines which are quite meaningless, which people draw on charts. So I'll work through an example. So this is a current chart of NAB, National Australia Bank, and what I often see people do with charts and trend lines. So I'll just say for example, they call up this chart. They go, okay, I'm going to draw a trend line, and they'll get a low, and they'll get another low, and they'll join them together and go, okay, there we go. There's my trend line in NAB. But that's actually a meaningless line. Like, why this point? Why not that point? Or why not that point? Why not that point? It's like you can draw a line anywhere, and it doesn't tell you a lot. Like, you can put a line up through there, and it's just, well, what's it telling you? Not very much. Or you can wiggle it around, and you can draw a line up through there. And again, it's not really telling you a great deal. So that's why I say, like, good trend lines are hard to find, and it's for a lot of people, it's I think this is a problem people run into at charting. I think it's why a lot of people get skeptical of charting, because it's easy to draw lines everywhere, and most lines don't really mean a great deal. Better example of a trend line you can get in Westpac. So I'm just going to compress this data. Actually, I'll put it on a weekly chart so we can get a little bit more data there. And you can see now this has multiple touch points as you come down. So that's a trend line which is worth watching. But as I say, they're easy to draw, and it's easy to draw something which doesn't mean a great deal. I think for most people, using moving averages is really a better form of trend assessment. Just look, it's really simple. Like, I've got a 50 and a 100-day moving average here. If the price is above the moving averages, I'd say the market is warm. If the market is below the moving averages, I'd say it's cool or cold. I don't want to invest when it's cool or cold. I want to invest when it's warm or warming. I might not even want to invest when it's hot, because it may not be an asymmetric point to get in. But trend lines can be interesting, but as I say, it's you got to be able to draw them properly. And I think for a lot of people that can be challenging, because like a chart can be quite a confused thing to move around. It took years really for me to develop what I'd call a chart eye, where you can look at a chart and you can see the patterns. A lot of people will look at it, and it's just a whole lot of lines. It's not meant to be join the dot, where you're going from one point to another and a picture comes about. You do that on a stock chart, and you really get a messy situation which really doesn't add a lot of value, but instead probably adds quite a bit of confusion.
Yeah, fair enough. No, it's good advice. Actually, I'm gonna maybe just get you to test some of my knowledge here, Jason. If you go back to that, because I love trend lines myself, if you go back to that Domino's pizza chart there, so when I was taught that, if you get 3 touch points, obviously the line has to be pretty much aligned, 3 touch points, you've got yourself a trend line there.
Yep.
But if you go, I don't know what your rule is. Obviously 2 is not enough because you could do 2 lines on anywhere, right? But I think 3 was sort of my minimum.
Three was sort of the standard. Back in the charting department when I got my grounding back in 1992, it was 3 touch points, or if you've only got 2 but you can get a trend channel because you have touch points on the top side, well then that might work. But for a standalone trend line, as you say, Rog, 3 touch points. Otherwise, you're just joining up 2 points.
I'm glad, because now my education's all worthwhile now that I know the amount of money I spent on it. But now so from that third touch point on that trend line there, because I'm a little bit more aggressive than you are, right? Could I draw? I'm probably asking a rhetorical question here, but could I draw a trend line, right, that goes from there through those lines? So that third touch point you've got there.
Yep, right here.
Go up through the.
You're going to link these ones.
Yeah, all the way up to that break and retest there. Yeah, and go up a little bit more. This is where it's down to discretion, right? There, right about there, exactly. That to me would have been the first sign for me that Domino's is going downhill, which effectively it did, right? So I know it's easy in hindsight to say that, but that would have been my trend line. I'm a bit more aggressive than you, obviously. So
it's not bad. It gets a little bit messy through this point here. So then I'd wonder, like after this period had passed, I'd wonder, well, it doesn't need to be just tapped down a touch, but you still get the same sort of point. You're getting the same sort of general. I think from a general perspective, it shows that overall trajectory is no longer working and it's combined with that euphoric sort of blast off phase. But as I was saying, for most people, rather than saying, look, do I use, connect this point or that point or that point, or are the touch points enough? For most people, the 50 or the 100-day moving average will kind of do the same thing. As soon as Domino's starts declining below the 50-day moving average, and the averages start to roll over, I'm starting to get a bit worried. I'm going, look, I don't want to be adding to this situation. I'd want to wait for it to bounce off those averages, then I could consider it. But if it continues down below these averages, as it does, well, it does the same thing as breaking the trend line. So it just shows you don't. It's I think the beauty of the moving average is it's going to be consistent and it's not left to discretion.
Yeah.
Trend lines, there's a lot of discretion. If you've got that clear-cut one like we have with the 4 points, that's all good. But to save the issue of maybe drawing a line which doesn't really mean a great deal, as I say, for a lot of people, look at these moving averages because they are going to be consistent and they're not so much of a discretionary item. But look, what you did with that trend line, I think it works, but it also gives the same outcome as that moving average.
Yeah, dynamic trend lines are those moving averages, aren't they? So
very much. That's exactly what they are. Dynamic trend lines, which are always adjusting to the price action, and you can apply it to any stock or any market, and it's you get that consistency.
Yeah, I think so. All right. So what are reversal patterns? So obviously there's a few out there. Can we have some examples? Head and shoulders, bottoms, wedges.
Yeah.
I think you've got a few.
There are all sorts of reversal patterns. So we'll just go through three of the most common, the ones that you hear about the most often. So just jump back into these charts, and let's start with first of all, what I'll do before going to the charts, I'll just go through. I'll start with the head and shoulders, but I'll just go through the theory of the head and shoulders first. So this is what a head and shoulders pattern looks like. It's a lot of these patterns have pretty funny names, and I think the names can make them sound a little bit like, I don't know, maybe a little bit out there, but understanding the psychology behind them they all start to make a bit more sense. So this is a topping pattern, a head and shoulders top. And what you get a market which is rallying. You got a series of higher highs and higher lows. And then at some point the market comes back, starts to rally again, and people looking through the rearview mirror at the immediate past, they're expecting that sequence to continue. They're expecting the market to continue up to a new high. So people buy the dip, expecting the market to follow through, but there's not enough follow through buying this time. This time the market starts to stall, starts to pull back, breaks below previous lows, and then you get the sell sequence starts to come into play, where you get a series of lower lows and lower highs. And it's this break below these previous low points, which is, they call it the neckline. The break below there, that's the trigger for the new down sequence. So just understanding like how so moving away from, like, if you think the names sound a bit odd, just getting your head around the theory that we're looking for a market which has higher highs, higher lows, which then starts to stall and can't make a higher high and then breaks to a new low. That's really what the head and shoulders is all about. So let's go and have a look at some actual examples. So I just get these charts set up again. So let's have a look at, let's start with the S&P 500, because there's a few that pop up in this. So let me just line up where they are. So, well, first of all, here's one here. And I remember speaking about this in my weekly video. So you can see we've got markets declining, makes a low, it rallies, it's a lower high than previous, makes a new lower low, rallies back, starts to come off again. So this is where people are thinking, well, it'll probably make a new low. So people might sell ahead of the breakdown. They might get short, going through those inverse ETFs. Not enough follow through selling to make a new low though. The market rises above this previous low point, so it breaks that sequence of lower lows. That's when the shorts start to cover, new buying comes in, and that pushes the market higher. So as we were seeing this pattern form, and it was also then combining that with sentiment, market was getting a bit twitchy around this time, and you combine that with a breakout, so it gives you that sign that, look, maybe something's happening on the upside. Looking along further, and you also get one around this point last October that we were talking about earlier, and you can just draw this in. You can see the same thing. We've got the lower low, the lower high, another lower low, rallies back, but this time it falls, doesn't get that follow through momentum to the downside, breaks back up. Couple that with the sentiment that we're talking about, the extreme negativity of the time, and that even if it was just a shorter term period of short covering, it was enough to say, look, there's probably the path of least resistance in the near term is upwards. And that's something I actually said at the time of my weekly videos. I remember buying some S&P 500 around this time because we did have that sentiment shift. We had the negative sentiment, we had the reversal day. A few days later, we had the head and shoulders bottom, and there was enough things going on there to say, look, this is a market which looks like it could run. Here's another one here. See that they're actually a reasonably common pattern, just because it's that sequence where the lower lows is broken and higher highs start. So again, lower lows is broken at this point, forming that right shoulder, and then we have a higher high. And so yeah, it's one of those interesting charts to keep an eye on, those interesting patterns. Another one we can look at is in Goodman Group. So let me just expand this out, and so this is a large one. There's actually a couple on this chart. So interesting. Just if you're looking at it, can you spot them before I draw them in? And so the first one I'll show, we'll start with the head and shoulders top. So what I'm doing, I'm going to link up the low points, and so you can see this. What you're doing as an investor, you can see the moving averages have crossed, You can see the marker's becoming vulnerable. It's trading below the moving averages. It tries to rally, but it starts to stall. So these are all warning signs that all is not well. And you can start to see the pattern start to form. So even before it's formed, even at this point here, you're going, well, look, could this be a potential head and shoulders forming? Because I can see the market's below the averages. The averages have crossed. It's rallying, but is this rally going to fail? And this is where you could be like putting in this trend line here for the neckline. And as it comes across, it starts to break. So you say, look, this is breaking lower. This isn't a situation to be in. It's not a buy the dip. It's if I've got a position, maybe I want to be selling it. And then you can see the market continues to fall away. Over here, we've got, let's get rid of that. Another pattern here. We get a head and shoulders bottom running across like that. So we get a shoulder, we get a head, and we get a shoulder through there. There we get the big neckline, and we've got that breakout. We've had a return move. That's something you often get in with technical patterns. You get a break, you get the break, and then the market will come back and retest where it broke from. It doesn't always happen, but it happens quite a bit. And we're getting a rebound off there. It'll be interesting to see whether in the current environment where stocks are under pressure, whether this break will hold and whether this can rally. But this has been a relatively strong stock. Goodman Group has been relatively strong in a market which has been struggling. And these patterns don't work every time by any stretch. It's all about managing risk and reward. So you know that you've got upside potential when you get a breakout from these patterns. So it's what we call asymmetric, in that you can manage your risk. You can have a reasonably close exit strategy. Doesn't mean like 5% or something. You might have 10% or 20%, whatever your strategy may be. You can give it a bit of room, but you know you've got upside potential, which is potentially going to be much greater than your downside. So that's why we say asymmetric. Looking at another example, and you can see that it's not just one stock where you get these examples. You get them quite a bit, and this is a little bit like you can see it's interesting. Like why I say it takes time to develop a chart eye, because I didn't spot this one initially myself. It's only when you look at it and really start to process it that you can see we have a shoulder here. We've got a low, rallies up, but doesn't break the previous high. So it's a lower high. Get a new low, so we've got a lower low. So this is the head forming. Rallies up, doesn't break previous high point. So the downtrend is still intact. Falls, but it doesn't continue getting that downward momentum. You can see the moving averages now starting to plateau and starting to turn. And this is where we can draw our probably across here. This would be the point to draw it. So shoulder, a head, there's a shoulder. Couple that in with the moving averages starting to turn higher, and there you get the breakout and you get the market running. Just quickly while we're here, there's a little head and shoulders top, shoulder, head, shoulder. So again, it's not so much about looking for obscure patterns. It's just looking at price action of higher highs, higher lows, lower highs, lower lows, and bringing them all together. And then it's and it often doesn't play out as neatly as in the textbooks. It's that's why I'm talking through like moving averages moving as well. These patterns can be a bit messy at times, but it's like trying to couple it with sentiment, couple it with moving averages, looking for breakout points. Just quickly, let's look at let's move along. Let's have a look at a rounding base. That's another type of pattern. What's a good example for that? So this is a good example in IAG of a rounding base. So I'm just going to compress that. And this is just typical of the sort of price action which markets bottom in. So I'm going to use this arc, and let me just show. It comes clear as you put the pattern on. And see how we've got these lower lows. The lows start to, the downward momentum starts to subside. And you can see then we get this series of higher lows start to form. That's where you get that rounding pattern. And this is classic of how a lot of markets bottom out. And you see this quite a bit. You can get rounding tops as well. I particularly like the rounding bottom formations. And then I'll be, of course, looking at those moving averages, and then I'll be looking for breakouts. I might look at a resistance point. So you can see there's you can get some resistance comes along there. So we spoke about support and resistance a couple of weeks ago. Some clear resistance. You got a rounding bottom. You got the moving averages cross, and you get a breakout. So that becomes quite an interesting situation. So this is a current pattern in progress, you could say, because it's this is IAG. It's sitting above that. It's that resistance is now support. Will this be able to follow through in the upside? It's we don't have the tailwind of a rising ASX 200. So that always means you've got to be a little bit more careful with these patterns. I'd much prefer to go with these breakouts when we've got a general rising trend. But nonetheless, this is a sort of stock which I'd have a look at. And I'll show you what can happen with a rising base. So this is a stock called Duratec. And this is one I've got in my portfolio. It turned up in the Motion Trader Signals might have been about a year ago. And you'll see that same rounding basing structure. Let me just draw this in. So you see this, Roger? We've got the lower lows, and then the lower lows stop. We start getting higher lows, and that's the rounding part of it. Again, you can get. Let's see. You can get some resistance, through around 45 cents or so. The moving averages had crossed, so we've got cross moving averages with higher lows. And then a break above resistance. So this is somewhere around where Motion Trader picked it up in the daily signals, and I got it into my own portfolio. And it's not dissimilar to IAG in that you can see we've got the break, and then we've got that zigzag correction back to the moving averages. Let's just go back to this for a sec, and you can see we've got the rounding base, got the breakout, we've got the zigzag correction back to support. Come back to Duratec. You can see where this goes already, can't you? And back to the averages, and then it's off and away. So that's not to say IAG is going to do that, because nothing is perfect, but we're looking for setups that have the potential to do something interesting, and then we're managing risk around it. So it's like some of these will fail. IAG might fail. It might not do what Duratec's done. Instead, it could just start to fail around the moving averages and then break back down. That will always happen, but that's where you have your exit stop. So you cut it. So you get in, you take a relatively small loss, and you move on. That's when they don't work. When they do work, you let them run, and you can make a lot of money. So it's an asymmetric entry point. I think you're putting the odds in your favour when you follow that sort of setup. And that gives you the potential to do well. Just another one, which is like IAG at the moment. This is PointsBet's holding, and it's an interesting one because it's a really down and out sort of stock. Look where it's fallen from. It's fallen from huge heights. So maybe this one won't come good. I don't know. Or maybe it's a recovery story. I really don't know. I don't know the fundamentals behind it, but just looking at it, you can see it's got that same rounding situation. We've got the lower lows. The lower lows stop becoming lower and start becoming higher. We've got a breakout. It's a breakout. Let's see. I can probably get some resistance round about where the market kind of currently is. We've got a breakout. It's just pulling back at the moment. So is this going to find support around 73 sort of cents? I think the key for this one would be probably staying above this low point at around 68. If it stays above there, well, then we've got that sequence of higher lows, and it then has the potential to do what Duratec did, and you get that sort of sequence. That may not happen. It may fail. It may roll back down. That's where you cut. That's where you potentially cut a position anyway. And go, okay, that one didn't work. And that's okay. A lot of these patterns won't work. A lot will fail. But if you can keep your losses relatively small when they don't work, really, run for the fences when they're going and make some good money. It's that's how the whole thing starts to play out. And just quickly, just having a look at a wedge, a bullish wedge. So this is from the NASDAQ, and this was another interesting one. So this is the NASDAQ 100. You can see these green converging trend lines. And the way a bullish wedge works is that the momentum starts to subside as it moves closer to the apex, which is like where the green lines ultimately converge. And the trigger point for the pattern is when you get a breakout above the declining outer boundary. That's the break. Had a run, pull back, had that return move we spoke about earlier, return move to the breakout point, and then it's run. So this was all happening around that October low. There's that October low. So this is why I say I'm bringing a whole lot of things together when I'm trying to synthesize what's going on. I'm looking at sentiment. I'm looking at the moving averages. I'm looking how the price actions reacting to news. I'm looking at parallel markets like the NASDAQ. What patterns am I seeing in that? And you're trying to put all these pieces together to form some sort of view on what's happening, to sort of like try and guide us through the price action and help look for those asymmetric setups like we saw in some of those stocks. But with full knowledge that nothing's perfect and nothing's going to work all the time. We don't need that. I think that throws some people off. They go, "Oh, look, your methods only work, only work really well 1 in 4 times, or 1 in 3 times, or 1 in 5 times, or what it may be." But you only need to, if you can get a stock that doubles 1 in 4 times or 1 in 5 times, and you can have moderate gains and small losses on the other occasions, you're probably going to put yourself in a position to outperform. So it's not about every stock having to be 100% winner. You want to be fishing in the right spot. You're going to get a few snags, but when you get the big one, you just let it run, and that's how the people who do well in this game can do really well.
Yeah. Now, look, I really like the head and shoulders patterns, especially the inverse ones, the ones at the bottom, because if you're buying a stock, as you can only do on you can sell, but I'm saying at the bottom, you're looking for those inverse head and shoulder patterns. And to me, it's just logic, right? If you've got a formation of a head, and then it just makes a right shoulder which is higher than a head, then logically it sounds like and same with that rounding base, which we used to call cup and handle. It's just logic that it seems like that the price potentially is heading up at that point, right? So another one we wanted to quickly talk about, Jason, obviously, and this is a very common one in our industry, is the tops and bottoms, double tops, double bottoms. Can you show us how we can identify some of those?
Yeah, double tops, double bottoms, triple tops, all this sort of thing. They're all quite interesting. It all comes around support and resistance, which we've spoken about. And let's jump over and have a look at a few charts of that. So let's see. So double tops. Double tops really form when markets reach a previous peak and stall, and that's when supply is coming in at the old high. So you can even see it on this NASDAQ. This is just on a very short-term basis. You could say there was you could call that a bit of a double top, in that the market's retested a previous high and it stalled, supplies come in, and the market started to sell off. And it can be a reversal pattern, or sometimes it's just a holding pattern as the market just builds up the energy to punch through. So here's an example of copper from a few years back. And you'll often see I've already got lines drawn on these charts, because that's what I use them in my weekly strategy sessions. And so I keep the lines there so they stay from week to week. Now, let me just go. I've got to go back a little bit further on this. So this is a good example in copper. So you could call this possibly a double or a triple top, but there's certainly a whole lot of overhead resistance you can draw in. And this is where the supplies come onto the market, and it has been a significant reversal. We've had a large sell-off afterwards. So that's one scenario from when you get these double, triple topping type formations. But then you get others where it's more of a holding pattern. And this is an example from gold. So you can see gold's had rallied into a high, it's pulled back, it's rallied back to the previous high, supplies come in, resistance has been found, it's backed off, it's rallied back again, the selling's come in just beneath the double top or the resistance point, backed off, and then ultimately it's run again and it's broken. So it's taken time for it to build the energy to punch through a resistance point. So a double top, it's something to bear in mind in terms of, well, firstly, you've got like, as a market is approaching a previous high and you've got the potential of a double top, it's a case of, is this an asymmetric entry point? Is this where I want to buy? Do I want to buy just as the market is approaching resistance? And my answer to that would be, no, I don't want to do that, because my potential upside at this point could be capped by resistance and my downside is open. So we can use double tops, triple tops, whatever it may be, for that sort of perspective. But then we can also use it if a market continues to sit beneath it and then ultimately break above it. Well, then the asymmetric equation flips and it becomes considerably positive, in that we've got you get a breakout. You can then manage your risk with a stop beneath the breakout point, and you can let the market run and see what it does. In this case, gold goes on a great run. Interesting situation now. Move it forward to present day, and we've got a triple top in gold. And this is one of the things I spoke about in real time on my strategy sessions, as gold was approaching what was in a double top. I was saying, look, not an asymmetric entry point, because we're just nearing double top resistance. So if I've got gold, I probably still want to hold it, because I want to stay with the overall trend, which I thought was still positive, but I probably don't want to add at this point. So I'm using a resistance structure to help me decide when I want to add, when I want to hold, when I just want to sit and watch. And sure enough, it hasn't been able to get through on this occasion. It's pulled back, and now this is what makes gold so interesting. Now it's like this is a bit like this earlier situation where it trundled sideways for what's that, three or so years, built up energy, and then punched through. Will that happen here? Is it trundling along sideways in a large range, building up energy to potentially punch through? We don't know. Maybe that won't happen. Maybe it will ebb away and start to fall off. We'll only know as it breaks levels. We've got a support level beneath the market. We've got a resistance level above it. We're in the middle of that range at the moment. So it's a case of wait and see. But should gold continue to go sideways and break that resistance point, then you get that asymmetric opportunity to potentially jump on board and build a good position with a controlled risk situation. The ASX 200, not in a dissimilar situation in that. So we've had this big run off that March 2020 low, and when the market was peaking back in August 21, you can see it's retested that high in January 22, retested it again in April 22. So we get the triple top resistance. Had you been following the market in April 22, going, well, now is now a time to buy, based on what we've just been discussing, you'd probably say, well, no, it's probably not an asymmetric entry point, because we're just beneath overhead resistance. There's a good possibility some supply could come in, particularly since the market's had a good run off its lows. Maybe it will pause. The pause was quite a big pause. It was actually quite a big sell-off. You don't know that at the time, but you just know the risk reward probably doesn't favour an entry point at that stage. And now we have a market which is trading sideways beneath this large overhead resistance. So it's going to be interesting to see how the ASX 200 plays out. Will it play out like that earlier gold example, where it's building up the energy to ultimately break to the top side? Or is it going to start to roll over and head back and test these lows? and we don't know the answer to that. It's we can't know that, but we know where the levels are. We know where we start getting really positive in the ASX 200 if it can. Probably a case of when, really, isn't it? At some point, it should break above 7,600. We just don't know whether it's this year, next year, the year after, or when it may be. It's a case of wait and see. And but this is how I'd use support and resistance and double tops to try and look for those opportunities. Just one more example, the European stocks. So this is the Euro Stocks 50 index, which has a potential double top forming right now. And so that would have implications for global equities as well. It's something interesting to be aware of, that we do have that double top at the moment. Supply came in around a previous high. The highs from November 21, currently consolidating below declining moving averages. So you'd say that's at a point of vulnerability. So if the European stocks go down, maybe that you wonder, like, how does that play in with the US stocks, the local stocks? So it's interesting things to consider. Double bottoms. You can see how we had a great double bottom in 2022. This is when everything was really taking off in Ukraine. They were talking about Europe wouldn't have energy for the winter. The market broke below this double bottom, failed straight away, came straight back up, and that was a sign that everyone who'd wanted to sell had already sold. And sure enough, we got the rally. So that was a sentiment type play, leveraging off what we could see happening in the price action. A couple of other double bottoms where you can see market retests a previous low, can't get follow through selling, finds demand coming in, and one more over here. So they can be useful things to keep an eye out for. They don't occur all the time, but when you get them, they can lead to some interesting opportunities.
Yeah, I think so. All right, so let's just finish with a couple of questions here, Jason. What's your thoughts on the RSI indicator? Is it good to indicate for fear and greed, or?
I like the RSI sometimes. It's a lot of the time I don't find it particularly helpful. I find it most helpful when I get divergence. So that's where you get a situation where, say, a stock might reach a new high, but the RSI doesn't go on and make a new high above its previous high, and you get a divergent situation. That's when I like the RSI the most. Much of the time, it's just I don't think it tells us a great deal. A market can stay overbought or oversold for a considerable period. So in a rising bull market, you'll often find the RSI appears overbought. But if you sold on the basis of that, you'd be looking at the market maybe 6 months later going, well, that didn't really work out too well because the market's kept going up. So I'd rather use other factors like the moving averages, breaking of support, rather than just looking at an RSI. So as I say, I'd look for divergent situation and then couple that with the price action. If the price action starts to stall, when the RSI hasn't confirmed an earlier break, that's when RSI can be quite helpful.
Yeah, I think we might dive. We'll go into that in another week, actually, on our indicators. A couple of weeks, we're going to be doing our indicators. We can talk more about divergences, I think, because that is I like seeing divergences, and helps with seeing what potentially can happen in the future. But it's not a good sign of what to do right there and then, right? So
it's a warning. It's sort of like you're getting a red flag, and you can see divergence can be helpful when I compare the NASDAQ and the S&P 500, or look, what can you do locally? Maybe you're looking at the ASX 200 and the banks index, or you can just find related markets and look for where one's not confirming the other, and that can give you divergence. And it's not necessarily going to tell you that the market's going to reverse course, but it's a flag to pay attention because it might reverse. Sometimes the lagging market will then catch up and the divergence disappears and you don't see it. You often only see it in hindsight. Look back and go, oh, geez, that was all nice and clear, and you don't see the times when it didn't work because the market is caught up. But that's why I say it's a flag, not a signal.
Yeah, very good. And then what's your thoughts on RMD?
RMD, let's jump over to the charts and have a look. So RMD would be ResMed. Let's go to present day. Yeah, well, that's well, look, yeah, it's interesting, all the things that we've spoken about. So from a temperature perspective, taking ResMed's temperature, would we say this is a hot market, a warm, a cooling, or a cold market? And I think given the position of the moving averages and where the price is, I'd say this market is cold. This is not a market which I want to, not a stock that I want to consider buying at this stage. It's not a stock which I think I'd have in my portfolio either, because if I did have it, I think my exit point would have been somewhat higher as it was breaking below some of these previous lows. So I probably wouldn't have it at this point. I don't know where it goes from here. Is it going to be forming a low? Let's have a look at an RSI. We just spoke about RSIs. See whether that tells us anything. It may tell us nothing.
It's a relative strength index. Yeah,
maybe interesting. And look, it's kind of, maybe it's a little bit interesting in that ResMed almost made a new low, but the RSI is nowhere near that. So that's, has some makings of some divergence. It's not clear divergence because it hasn't really made a new low, but the price and the RSI are doing different things. So that's interesting. I certainly don't want to buy it. I'm not going to try and pick the low in a stock like this. For me, it would take time for it to trund along. Like, is it a rounding base? Do you get some? There we go. Do we get, like, is it a basing type period it needs to go through within start getting the higher highs, higher lows, giving the moving averages time to turn and start to go upwards? Like, I don't know. I don't know what the price action could be, but from a risk reward perspective, I'd stand clear at this point.
Yep. Fair enough. I think that's it for questions for today, Jason. I think we were out of time as well. So thank you very much once again for an amazing session. Next week we are going to talk. We're going to start a couple of sessions on actual indicators. So we're going to go back onto moving averages. We're talking about continuation patterns and what's associated with that, obviously. So I'm looking forward to that, Jason. Guys, if whoever's on, please do like and subscribe and put any comments you want down below. We appreciate that. Check out the links. Obviously, check out the links to Jason's service as well as Selfwealth, obviously, if you're not already a member. And yeah, thanks for a great session again, Jace.
Yeah, that's been fun. Hopefully it gives everyone a few more ideas about combining charts with sentiment and everything else. And yeah, I'm looking forward to talking about moving averages. I think it's it's my favorite indicator. So let's get into it.
Yep, and I'll be looking out for those head and shoulder patterns everywhere this week. You've confirmed that that's my favorite pattern. So thank you very much.
Good one. Thanks, Roger. It's been good.
Thanks, mate. Take care. Bye-bye.
See ya.